This lecture introduces the subfield of international finance by providing an overview of exchange rates, exchange rate regimes, and the foreign exchange market. International finance is the macro side of international economics. Here we focus on the pricing of currency and the domestic and institutional structures that facilitate international transactions through currency exchanges. Within international finance, we shall therefore focus broadly on exchange rates and open economy macroeconomics. In the former, we shall look at the theory of exchange rate determination, as well as the institutional structures or regimes that countries put in place that help determine these exchange rates. In the latter, we shall look at a country's international transaction accounts, also known as the balance of payment accounts, and show how its component parts reflect the international investment position of a country, as well as helps to explain the transmission of economic policies in a global setting. The motivation for our first focus on exchange rate theory is to understand how currencies are priced. So why is the dollar-euro exchange rate, for example, priced at $1.05 per euro? This theory is important ultimately because all of the prior international transactions we studied under international trade are only feasible in practice if an acceptable exchange rate between trading countries exists. This exchange rate makes it possible for consumers in one country to purchase goods and services from another country. The exchange rate is therefore in a sense a price that has to be predetermined before subsequent other goods can be traded across countries, implicitly at that price. Formally, the exchange rate is the price at which one currency trades for another. The market where such currency trades takes place is called the foreign exchange market or the Forex market. Expressing the price of a currency can be done in one of two ways. There is a direct way and an indirect way. This requires determining first the home country for any two given countries, and then a direct quote would be expressing how many units of the home country's currency are required to purchase a unit of the foreign country's currency. If, as in our subsequent illustration, the US is the home country, the direct quote, also referred to as expressing the exchange rate in American terms, will be how many US dollars are needed to purchase one unit of the foreign currency. If the foreign currency, for example, were the euro, the direct quote would be called the dollar-euro exchange rate. An indirect quote, on the other hand, would be expressing how many units of the foreign currency are required to purchase a unit of the home country's currency. Thus, given the euro as the foreign currency, the indirect quote or the exchange rate in European terms would be the euro-dollar exchange rate. The indirect quote can numerically be found by the inverse of the direct quote, and vice versa, as in this example. Let's look at a couple illustrations of this concept. First, we have a German tourist wanting to visit the US, hoping to see the Great American Waterways. The German is ordinarily resident in Germany, where the euro is the legal tender. However, the tour is in the United States and costs $8,400. The question is, if the US dollar-euro exchange rate is 1.20, then how much does the German need to have in euros to make this tour a reality? The US dollar-euro exchange rate is a direct quote, given the US as the home country. It says it takes $1.20 to buy 1 euro. Therefore, since the cost of the tour is $8,400, then this will require the equivalent of 7,000 euros given the exchange rate. And this is computed on this slide. As a second example, let's suppose a fashion business located in Michigan is looking to import clothing from India and has budgeted $50,000 for this. The Indian rupee US dollar exchange rate is 70, and each unit of the clothing costs 1,750 rupees. How many of these can the fashion business purchase? The first thing to note here is that the exchange rate is quoted in Indian terms, which is an indirect quote, assuming the US as the home country. That is, 70 rupees are required in exchange for $1 US. We can go ahead and compute that the fashion business's budget will be equivalent to 3.5 million rupees. And in turn, this will allow for 2,000 units of clothing to be purchased from India. So far so good. Now let's introduce some more concepts. First, a currency appreciation. A currency is said to appreciate against another currency when fewer quantities of that first currency are now required to purchase a unit of the second currency. If the exchange rate is quoted directly, say as a dollar-euro exchange rate, then its value goes down if the dollar has appreciated or strengthened against the euro. For example, if it was 1.05 and it's now 1, then the dollar has appreciated or strengthened against the euro, since less of it is now required to purchase 1 euro. Similarly, the concept of currency depreciation means the opposite has happened. It now takes more of the first currency to purchase a unit of the second currency. Thus, using the same dollar-euro exchange rate, if that goes up from 105 to 110, then the dollar has depreciated or weakened against the euro. It is instructive to note that for any two currencies, if one is appreciating against the other, then the other must be depreciating against the one. However, the magnitudes of depreciation and appreciation need not be the same. We discuss this next. The magnitude of a currency depreciation is the percent change in the exchange rate over some relevant time period. If this is computed to be a negative value, then it is clear that the future exchange rate's value has fallen. So, a direct quote means the home country's currency has appreciated. We, however, interpret the magnitude from the perspective of the second or foreign currency and say it has depreciated against the home country by that magnitude. If the value was positive, we say the foreign currency has appreciated against the home country by that magnitude. In many instances, how exactly it is described might be trivial, but this is very important, especially because this is actually accurate in terms of describing what has happened with respect to the two countries' currencies. Consider the following illustration. If the dollar-pound exchange rate was previously $1.50 per pound, and it has now fallen to $1.42 per pound, the computed percent change in this is negative 5.3%. Now, while it is clear that the dollar has appreciated against the pound, however, in terms of the computed magnitude, the correct interpretation is that the pound has weakened or depreciated against the dollar by 5.3%. Consider a second illustration. The euro-pound exchange rate was at 1.30 and then it dropped to 1.25. The question is, by how much the euro has appreciated or depreciated against the pound? If we compute the percent change using these numbers, we will get an answer for how much the pound changed against the euro, but that need not be the same as how much the euro changed against the pound. So we need to convert the euro pound rates to pound euro rates by taking the inverse of these. Then, when we compute the percent change of these, we have an answer for how the euro has changed against the pound. So doing this, we have this computed as equal to 4%. The interpretation here is the euro has appreciated against the British pound by 4%. Note that if we had simply used the initial values, we would have computed the percent change as negative 3.8%. That is, the British pound depreciated by 3.8% against the euro. As stated before, the difference here might appear numerically trivial, but it is inaccurate, and in many applications, a 0.2% change is actually not trivial. The foregoing has looked at bilateral exchange rates. We might often be interested in multilateral exchange rates, that is, how a country's currency might be comparable to multiple other currencies taken together. While we do not have an explicit number to reflect such a rate, a multilateral exchange rate can be inferred through computing a change in a country's effective exchange rate, which is done by summing across a weighted percent change in the bilateral exchange rate of the country with that of its trade partners. The weights in this case are given by the respective bilateral trade shares. Again, we interpret the change using the standard convention we have discussed already for appreciation and depreciation. We illustrate this as follows. Keeping the analysis tractable, we assume the US has only three trade partners, China, Mexico, and Canada, and the trade shares with each correspond to 32%, 28%, and 40% respectively. If over the last year the US dollar appreciated by 2% and 10% over the Chinese yuan and the Mexican peso, respectively, but depreciated against the Canadian dollar by 4%. We can go ahead to compute the percent change in the effective exchange rate as an inferred measure of a multilateral exchange rate. So we weight each of these changes by the respective trade shares, and summing gives us a value in percent at 1.84%. How do we interpret this? The US dollar has appreciated against a basket of currencies given by that of its trade partners by 1.84%. When thinking about the concepts of appreciation and depreciation of a currency, we are assuming that there are underlying events taking place within or across countries causing the exchange rate to change. We will discuss this later when we get to exchange rate theory. But it's important to note that countries may choose to determine whether to allow their bilateral exchange rates, at least from their own perspective, to fluctuate with these events or to remain at some predetermined level or somewhere in between these two. This is what's referred to as a choice of an exchange rate regime. We generally distinguish between two broad types of regimes: a flexible or floating regime and a fixed or pegged regime. In the former, the exchange rate is allowed to respond to the events and changes that occur in the global environment that ultimately influence its magnitude, whereas in the latter, there is within the country a deliberate effort taken to keep the exchange rate in place and resistant to these global events and changes. See Figure 10.4 and the accompanying discussion in your text on the real-world varied regimes that exist, which include hybrids of these two polar regime forms. The naturally important question is what influences the choice countries make when choosing one regime form over another. Countries typically have to make the choice based on perceived trade-offs and objectives which they have in mind. More generally, those that have floating regimes tend to be advanced economies that are seeking to harness market forces, especially if their economies are largely market oriented, so as to achieve more efficient pricing and resource allocation within their economies. Further, as we shall discuss later on, floating regimes permit full autonomy with respect to utilizing monetary policy for economic objectives. On the other hand, those that choose pegged regimes are either looking for some form of price stability by pegging their currency to, say, a low inflation countries at a fixed rate, or and they are hoping for economic stability if they believe that their economies are largely similar to that of the other countries whose currency is being pegged to. This way, external shocks do not lead to destabilization in their economies if the other country responds properly to those shocks. But more generally, pegged regimes allow for efficiency in international transactions the more the economies are economically integrated on other dimensions, say either through trade or through politics or through cultural similarities. Now that we have taken a cursory look at exchange rates and possible exchange rate regimes, let us discuss briefly the important foreign exchange or forex market, where any given exchange rate is formally determined. Unlike most other markets you might be familiar with, the foreign exchange market is more of an amalgam of numerous interlinked locations globally where currencies of all kinds are traded. The three largest of such locations by volume of trade are in London, New York, and Tokyo, and the most traded currency is the US dollar. The dominant players in this market are banks, which operate largely as middlemen in linking all the numerous individuals and firms seeking currency exchanges to carry out international transactions. As middlemen, they get paid for their services, and this in practice is included in the exchange rate that individuals face when trying to convert one currency to another. We next discuss the main types of contracts that are routinely carried out in forex markets. In general, we distinguish between two main types of contracts that are carried out in the forex market: the spot contract and derivative contracts. The former is simply a transaction in which contract and delivery happen right away, that is, on the spot, and as such involve no risk. The latter include forwards, swaps, futures, and options, which are all transactions where settlement date differs from the contract date. Whenever we talk about an exchange rate defined nominally as some amount of currency being traded for a unit of another at some particular point in time, as we've been doing, we are in effect describing a spot contract. And so we have here the US dollar euro exchange rate or spot rate between 2012 and early 2016. As seen, this has fluctuated over time between 1.4 and 1.08. In general, this shows the dollar has been strengthening against the euro over time. When it comes to foreign exchange derivatives, we have first forward contracts, where the contract has a settlement date for the currency exchange in the future, but the rate is agreed upon today. We have futures, which are similar to the forward contract, but they have more structure to them. Futures have regular dates when they mature, and they can be traded in futures exchanges. We then have swaps, which combine a spot transaction with a forward repurchase of the same currency. On this slide, we discuss each of these three and provide examples for each. We then have foreign exchange options, which, as with all options, could be call or right to buy options, or put or right to sell options. Options are similar to forward contracts except they need not be exercised at the time of maturity. Now, a more thorough discussion of these derivatives is reserved for a different course, say in financial mathematics or personal finance, as that's not within the scope of this course. However, it's important to get a sense of how these contracts make hedging and speculation possible in foreign exchange markets. So we're going to spend some time looking at a couple basic illustrations just to demonstrate this. As an example of hedging, let's suppose we have a French company with a US subsidiary that receives goods it ships to them for sales in the US. The French company expects payments in US dollars for some shipment to clients in the US in 3 months. The spot dollar-euro exchange rate is 1.05. If the French company, expecting to convert the dollar payments to euros, decides to purchase 3-month call options on euros, which have a strike price of 1.10, the company may be doing so as a hedging mechanism. That is, it's hoping to avoid the risk of an adverse fluctuation in the exchange rate that reduces its euro payments in the future. In this case, the company believes that the dollar may weaken to more than 1.10 at the time of payment and therefore purchase fewer euros. The call option therefore gives the firm the right to purchase euros at the time of maturity at the strike price, which is 1.10, and the firm will do so if at that time the exchange rate is greater than 1.10. But it will choose not to exercise the right if it's less than 1.10. Speculation also happens with foreign exchange, and this is where a trader may hope to gain from changes in the exchange rate that the market fails to accurately predict in its pricing of derivatives. So let's suppose John, a currency trader, has $10,000 and the current dollar-yen exchange rate is 0.01. 12-month forward contracts on the dollar-yen provide a rate of 0.015, but John feels that the spot rate will not have changed over this period, so he purchases the forward contract. This is speculation. If he is correct, he makes a 50% profit as computed, that is by selling dollars for yen based on the forward contract and repurchasing dollars on the market at the spot rate which had not changed. If, however, John turned out to be wrong, he may make a loss, which happens if the dollar depreciates considerably to more than 0.015 per yen. Finally, here is an illustration that combines speculation and hedging. Go through it and make sure you understand it. We are now ready to summarize our introduction to international finance. We have introduced and defined the concept of exchange rates, have looked at the choice of exchange rate regimes, and have discussed, albeit briefly, the foreign exchange market and some of the key contracts that occur in the Forex market. It's important to note the sequence in this coverage. The need for currency conversion to make trade possible brings up exchange rates. Whether their bilateral exchange rates should be left alone to be determined by events and preferences globally, or be deliberately fixed, is a choice each country has to make given their objectives, but realizing the inherent trade-offs involved in making this choice. Finally, despite the regime choice, it's important to look more generally at how various contracts are determined in the Forex market, including the spot or current exchange rate. Note that a pegged regime does not mean that no foreign exchange market exists for that country. Rather, it means that actions are taken by the government within the foreign exchange market to ensure that the peg remains in place. Okay, we are now done with this brief foray. Read through chapter 10 as we will finish up the rest of that coverage in our next lecture, which takes us to the very important concept of arbitrage. But first, take the quiz associated with this lecture.